Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, January 20th with Shaun Burgess on our portfolio management team, fixed income. You know Shaun, he's joined us before to discuss both the equity and the fixed income markets. Shaun, a little bit of backing and filling in both asset classes this week. You did mention to me earlier you saw something interesting about Muni inflows, though.
Yeah, you know, the second week of inflows. Now, it might not seem like a lot, but we spent most of 2022 seeing outflows. So to see 2 good weeks of inflows, it's encouraging to us. Last week was a little over $2 billion, this week over $1 billion. So a really encouraging sign, and we're seeing the muni market show real strength in here. So we're seeing a continuation of that fourth quarter kind of rebound we were seeing into the first couple weeks of the year here. So very, very constructive to see that.
Yeah, and that's something that the fixed income team looks at. Inflows and outflows from mutual funds in fixed income, whether they're muni funds or whether they're taxable funds. If you recall last year when you would be on, Shaun, it was week after week of outflows.
Yeah, it was miserable. So it's nice to see the turnaround. Now we as you said, we look at these very closely. You take them with a little bit of a grain of salt because they can turn around. But those flows really dictate market action in most cases. So
sure does.
Very heavy.
I would say October, early November, when you were on a Friday, we had a couple of new issue deals in munis crease the 5% level. So they're meaning that municipalities were offering 5% tax-free bonds and new issues back in early November. Now, of course, these are longer bonds. We're talking bonds out 30 years or so. But today, those type of, say 30-year AA plus type issue, where's that trading?
So it depends on the coupon, but just to handicap, probably right around 4%.
Okay.
A 5% coupon, you might pay more than that. You probably would for a high quality name. We said then that 5% was a real giveaway. That was super attractive in our opinion. And even in today's environment, when you look at a 4% tax-free muni, taxable equivalent of 6 3/4, 8%, depending on what your tax bracket is, still very attractive, especially as you look at a 30-year Treasury today sitting at about a 350 or so.
Yeah, great. Over on the equity side, as I mentioned, a little backing and filling this week. One thing that has really been standing out in the day-to-day trading, and it's been going on for a couple months now, is the strength in international equities. And this week, for the first time in ages, international equities actually became the strongest asset class in a relative strength matrix that we follow here. I just want to push this chart up in front of you for a moment. The heading here is the percent of days as a number 1 ranked asset class in DALI. DALI is just a matrix we use. It's dynamic asset level investing, and it tries to show us which asset classes are strongest. Domestic equities, international equities, fixed income, currencies, commodities, or cash. What I wanted to take a quick peek at is the last 4 decades and what asset classes have exhibited the best relative strength. You see the 1990s, domestic equities, 76% of the time in that decade, domestic equities were the strongest asset class. When we go down to 2000s, 51% of the time, international equity. Interestingly enough, back in the 2000s was another period of rate hikes from late 04 through 06. The Fed raised rates, I think 16 times in a row. International equities actually held their own, and they were the strongest asset class 51% of the time. Then we get into the 2010s, 89% domestic equity. If you had a asset allocation model that you were investing, diversification killed you in the 2010s. Underperformance in all asset classes except domestic equities. That continued through the early 20s, but has changed. In terms of how we want to approach this, we just want to remain flexible. Sometimes I talk about a recency bias when we do these videos. Recency bias is a killer from an investment and trading standpoint. Because what has happened doesn't mean it's going to continue. So now when we're looking where to allocate capital, for the first time in quite a while, we have to give some real attention to including or increasing the international allocation in client portfolios. So I thought I would bring this to your attention as clients and viewers, because international has been so dead for so long that many folks may be a little underinvested in an asset class that's doing very well.
Yeah, it's nice to see that a week of some things we haven't seen in a long while at this point. So it's very encouraging.
Mark will always keep us on our toes.
I'm telling you, it will. It will.
Well, don't forget to like, comment, and subscribe so you can follow along with our weekly videos. And everybody enjoy the weekend. See you next week.